In Chapter 23, we'll be talking about budgetary control and responsibility accounting. In particular, we're going to be talking about static and flexible budgeting. First, let's talk about budgeting. Budgeting is important because budgeting allows you to develop a plan for what you think is going to happen in the future. We call that developing a budget. Once you develop a budget, then you can compare what actually happened to what you think was going to happen. What you think was going to happen is called the budget. Once you have the actual information and the budgeted information, then you can tell were you over budget or under budget, and what you can do is you can take corrective action. And that's going to allow you to modify future plans, and then you go through the entire process again. Then the next period or the next month, you'll develop a new budget. You'll compare what actually happened to your budget, take corrective action, modify your plans. So budgeting is something that happens on an ongoing basis. It's not just a one-time thing. And budgeting allows you to develop a strategy and evaluate how well you're doing. Now, the two important budgets that you need to know are the static budget, which we'll discuss here, and the flexible budget, which we'll discuss in just a moment. So the static budget is very easy to remember because the static budget is always the first budget you make, and the static budget is only at one level of activity. So here in the notes you can see it says one level of activity. So let's talk about what that means. Here's an example. So here we have the budget, the actual, and the difference. So you can see the budgeted cost or sales revenue, in this case, is $180,000. The actual revenue was $179,000, and you have a $1,000 difference. So if we just take the budget, the actual, and the difference, and if we just use the first budget that we make without making any modifications to it, we call that the static budget. So here you can see at the very bottom, you can see that the budget was $180,000. That's how much revenue we thought we were going to have. Actually, you can see at the bottom, the actual revenue was $179,000. So we made less revenue than we thought. So you can see the difference is $1,000 and it's unfavorable. Okay, so remember, bad, budget, actual, and the difference. So the difference is always a number, and it's either favorable or unfavorable. In this case, the difference, the variance is also what it's called, is unfavorable because we have less revenue than we thought we were going to have. So static budgets are good because they are the first budget you make. And notice in the notes here, it says it's appropriate for fixed costs because fixed costs are always the same no matter what. Static budgets are not good for variable costs because variable costs depend and they vary depending on what actually goes on. So the static budget is a good first budget to use, but if we need a more updated budget that's going to be more accurate and give us more information, we're going to call that a flexible budget. So let's take a look at a static budget. Here again you have the budget, the actual, and the difference. Okay, notice that the difference column, the difference is also called the variance. Notice that it's a number like $3,900 and it's either unfavorable or favorable. Okay, now once we have the static budget, we can create a more important budget that's going to help us to compare more of what's going on. We call that a flexible budget. Now, a flexible budget allows us to compare apples to apples. Okay, so let me give you an example of what that means. But first, you should know that a flexible budget is essentially a series of static budgets. It's more adaptable, and it's prepared for each type of budget. Okay, let me give you an example of what that means. Okay, so here, now you can see that the budget, it says production in units. So we create a budget for 10,000 units. We think we're going to have 10,000 units produced. So you can see the cost that we expect. So for example, you can see indirect materials we think is going to be 250,000, indirect labor is 260,000, so on and so forth. The actual results are 12,000 units. So we have indirect materials 295,000, indirect labor 312,000. So you can see that this budget is called the static budget because it's the first budget we make. This is called the actual results. So you can compare budget, actual, and the difference, but this is not a good comparison. The reason why this is not a good comparison is because you actually produced 12,000 units, but your budget is only for producing 10,000 units. So we need to update this budget and say, okay, well, this budget is for 10,000 units, but what would the cost be if you had 12,000 units? So if we're going to update the budget and create a new updated budget, that's called a flexible budget. This first budget that you see here is called a static budget. So we can take this static budget and update it. Okay, so we're going to do a little bit of math here. All right. And we're going to figure out, well, how much was the cost per unit? And then we're going to update it for 12,000 units. And then this is what we have here. So you can see here, this is how much we expect the costs are going to be for 12,000 units. This is how much the costs are actually for 12,000 units. And then now you can make a better comparison. This updated budget is called a flexible budget. Okay, so we have the flexible budget, the actual, and the difference. So if somebody asks you to make a flexible budget report, then it would look like this. You can also figure out how much the costs are going to be at different levels of activity. So if we think we're going to have 8,000 direct labor hours, what are our costs going to be? So you can see. If you think your costs are going to be $9,000, well, what would the cost be? And then you can figure that out. 10,000, 11,000, 12,000. Okay, so the most important thing to remember in this lecture video is static budget is always the first budget that you make. And if you update the static budget, we call that a flexible budget. A flexible budget report figures out how much your costs are going to be if you, for example, make 12,000 units and compare that to how many units you actually made. And then you have budget, actual, and the difference. Remember, the difference is always a number and then a letter, like favorable or unfavorable.